Let's start by talking about the US economy, which has added fewer jobs than what was expected. The labor market has added 142,000 non-farm payroll jobs. Meanwhile, the unemployment rate has fallen to 4.2% from what was 4.3% in July. So this data comes after the US Federal Reserve has prepared to cut interest rates, and that has already been announced. The New York Fed President John Williams has reiterated this as well. He's called it an appropriate time for the central bank to reduce interest rates. Back at the markets at home, the Nifty we've seen take a plunge today, and this we've seen it post their biggest weekly decline in a span of 3 months. It has broken below 25,000. So against that backdrop, let's discuss what the US jobs data is indicating and what it really means for global markets, including our own. Market expert Ajay Bagga joins in on this discussion along with Manish Singh. Great to have you both, gentlemen. Manish Singh, to you first. Looking at this jobs data, I see the unemployment rate has climbed down to 4.2%, like I was telling our viewers. That more or less is on expected lines. But I was looking at the real unemployment rate, which is more nuanced. The real unemployment rate, it factors in those who are marginally attached to the workforce or even underemployed. So that real unemployment rate has edged up. It's gone up to 7.9%, which turns up as the highest reading since October 2021. Do you think this could be a worry for the Fed? Does it mean that the economy is actually shrinking and that the Fed has been behind the curve?
Yes, I think the short answer is yes. And even if you look at the headline unemployment rate, which is at 4.2%, you have to bear in mind that they're going to make the adjustment. You may recall 818,000 less jobs have been created between March last year and April this year. That adjustment will happen toward the end of the year. So when that comes in, you are clearly going to see the headline unemployment rate go up. In the short term, if you look at the trend in jobs being created, we have seen the June number has been revised again. It was revised earlier, second revision. July number has been revised down. I have little doubt that you're going to see revision on the August numbers as well when in a month's time. So on a headline basis, the data that you are seeing doesn't indicate that. Of course, it doesn't indicate a recession because you're not having job losses, but the slowdown signs are very clear. And it is now up to the Fed to see how they're going to ease it and can they prevent a recession.
Yes.
And to that end, I would see that they will have to cut rates bigger than the market is anticipating.
But would that perhaps indicate some kind of panic button being hit? Ajay Bagga, what's your reading of the jobs data from the US? Do you see this as the labor market cooling off like some quarters are reading? And if so, does this give the Fed enough breathing room to pace their interest rate cuts and prove that they are not behind the curve like some suspect? Or do you think it merits aggressive action like Manish is pointing out? And this action will unfold in less than 2 weeks?
I don't think aggressive action will come in because that will panic the market even more. Is the Fed behind the curve? Only time will tell. The models are broken because of the amount of monetary stimulus and the continued huge fiscal deficits, which are giving a stimulus into the economy. So the forecasting models are no longer working. That's why you're on data dependence, meeting to meeting kind of models. You're not forecasting anything. The dot plots are not worth the dots on which they are printed. So 25 basis points in September, they will not shake the market's confidence by coming out of with 50. Inflation, even the PCE index is at 2.6% run rate. So it's not that on a considered basis it's come to their target right now. They won't wait for 2%. That's for sure. That's why the market is factoring in 25 basis points. Half the market is talking about 50 basis, but I don't think because of two more behavioral patterns. One, the Fed will not want to acknowledge that they were wrong in July in not cutting, and that's why they are scrambling for a 50 basis point. Second, the signaling. Signaling will panic the market if you come in with 50. Third, if you see, there were red hot job data that was coming till the last 3 months, 200,000 odd jobs. Now you're getting to cruise speed Yes, the 89,000 jobs have been revised downwards for the previous 2 months. That remains a concern, but you have bad data, but you don't have a bad economy right now. So, the New York Fed president spoke about a 2.5% GDP growth in this year. That's the best forecast they have right now. We are not seeing that slowdown except for the bottom 20% of the US consumer, where you can see some amount of stress coming in. But the construction job growth today was a surprise, if you ask me, given what's happening on the housing market and the housing starts slowing down. I was expecting construction jobs to come in weaker, but they've grown by 30,000. So still a growing economy and not a time for them to put more fire. Then the inflation can go out of control. He doesn't want to be Arthur Burns. He wants to be a Paul Volcker. And there's not going to be any 50 basis point cut in a hurry.
So, Ajay, you believe that there are question marks on the quality of data that we are reading right now, but the economy remains resilient. So do you think that the markets are justified in the kind of slide that we've seen today in our part of the world just ahead of the weekend? And it certainly begs the question, how will the American jobs data influence the near-term trends in Indian equities, looking at this kind of data?
No, even the American markets were flattish to positive, and then we saw a brief bout of selling. I don't know right now.
Even right now, I was looking 0.5 percentage point cut, Ajay, on the Dow, and the Nasdaq is down by more than 1.5%, and a percentage point cut on the S&P.
If you see, the big tech must be really going down.
It is.
One more thing which we are not factoring in, markets are multidimensional, but it's the yen carry trade amount. The biggest trade in markets was short yen and long big tech. Now that is unwinding, Vikram. That has not gone through fully. And, the Bank of Japan governor's comments that he foresees further rate hikes in Japan. I think the market has got some worries on that part also. So not only this payroll data, but that's another dimension coming in. For Indian markets, we've had a very good run. Remember, at the budget time, we were at 21,200 on the Nifty. We saw a smart rally of 4,000 points. Now, some amount of steam is going out.
Yes.
But, nothing much to worry for the Indian markets is what I would say.
Fair enough. But Manish, would you agree that the American economy is still showing certain amount of resilience? And looking at these market conditions, do you think 25 is going to calm the markets and 50 is going to throw us in panic mode? Do you really believe it?
It is not indicating a recession. That's correct. But a 50 basis point rate cut is not going to panic the market. Because look at where the rates are, 5.25. Right, so we're not talking about rates are at 3 and you're going to 2.5%. That's not the case at all. And we are talking about historically high rates, and that was there to deal with inflation, which at least based on data is not a concern. So if you go from 5.25 to 4.75, that is not going to panic the market.
But Manish, where do you see it settling at? Because that remains an important piece. If you're going to see a 150 bips kind of cut, how it's going to happen, the pace at which it's going to happen is still in question, but it depends on where you see it settle.
I would say it's difficult to say, how many basis points you're going to get over next few months, because I think it's a very difficult question to answer. That'll depend on fiscal policy as well. So you have a US election, you will have to look at what the fiscal response is going to be from the new government or new administration. So I would say it's something looking too much into the future, but we have to look at the direction.
But the indication has been that it's the jobs data that is going to be the key in determining what kind of recession, if at all, the American economy is going to get hit by. You're saying very clearly that there is no recession on the horizon. Are you not concerned about the way the American economy is behaving, or that the data right now is not giving a clear picture?
I would say I'm not concerned about recession at this moment. But if the rates stay high for longer, then that will start building up into the economy. But don't forget the other side of it. The higher rates are helping the companies who have huge amount of deposits, especially tech companies, other companies, they're earning interest on that. Wealthy people, they earn interest on those things. So there is a flip side to it as well. Rate cut may actually start hurting some of these people who are earning higher interest rate. So a combination of the two will determine where the economy is going to go in recession or not. But on the basis of what we are seeing now, if you look at the President John Williams' comment today, job numbers reinforce cooling seen in labor market. What is cooling? The unemployment rate actually has gone down. Does he call it cooling? So you have to look beyond the data. Unemployment rate, at least on paper, has gone down. That doesn't signify cooling. But clearly he's hinting at what else he's seeing in the economy and what's happening on the job front. So if you take that in total together, they were prepared to cut rates last time, as you saw from FOMC meeting. I don't think if they do 50 is going to panic anyone, because a lot of people do expect that may happen. What happens after that will be important. And in my opinion, I think the fiscal policy is where you have to focus on. Right. The monetary policy will start easing if the inflation number stays intact, because you know the real rates will keep going up if you don't cut it, if inflation keeps falling. Right. But the fiscal part is going to determine what is going to happen and the extent of the cut.
Meanwhile, Ajay, today in our markets, we've seen most sectors getting hit. Whether you look at a Reliance or an SBI, ICICI Bank, they've taken the brunt. Infosys took it on the chin. But which sectors among Indian equities do you see risks to right now, and which ones do you see upsides on? Simply going by this jobs data, and whether it is perceived as a deeper economic problem in the US or a blip in what you're suggesting is an otherwise resilient market.
Yeah, we have to, the core thesis is US exceptionalism. So China slows down, Europe slows down, but the US will chug along. That is the basic thesis on what I'm giving this answer on. So I think Indian IT is well positioned now for a comeback, and we have seen ownership going up. And then the domestic focus segments. I think the big theme for India for the next 6 to 12 months is rural demand coming back. So you will see a lot of consumption plays do well, and rural is more correlated to two-wheelers and tractors. So within the auto pack, those two should do well. Banking has a spot of bother. The NIMs will come down. Even the RBI data is showing 11.7% growth in deposits, 15% in credit. So your credit deposit ratios are not kind of meeting the RBI expectations. The incremental ratios are definitely not meeting. So banks have to pay more for deposits. Again, as rate cuts come in by the Fed, I am expecting the RBI also to cut. We are at a very high rate, and that is having an impact on the economy. You might say you're still growing at just under 7% on real terms. So what is the problem? I don't know if that is RBI's thinking. Otherwise, I would say by December, you would have space to cut. So if RBI cuts, then the game will become which are the financials, which are fixed rate loans, which are the ones with floating rate repriceable loans. That will become the issue, and that's where the market has started taking positioning already.
Already, I'm looking at what's happening on Wall Street. I just mentioned it. Manish, S&P right now falling 1%, and it's going to be the worst week in a year. And it's happening all in the back of tech selling, something that we were just talking about with Ajay as well. And of course, the weak jobs data. But Manish, I'm also looking at that data that shows that FIIs are net sellers today, and DIIs here in India, they're the net buyers. I'm also seeing that India's weight in the MSCI Emerging Markets Index has surpassed China's, and now we've reached the highest level so far. Do you see further reductions in foreign capital parked in Indian stocks? Are investors abroad worried about valuations in Indian equities?
Yeah, I would say that, people who are investing in India for medium term, they're not panicked, right? They will take everything as an opportunity. If you look at the day-to-day and weekly movement, then that's difficult to justify. To your point about what you're seeing on S&P, let's not forget this is September. And if you look at the seasonality, September seasonality, and how volatile the markets have been, you don't have post-return. I mean, this month, we haven't seen a green end of the day, as far as I recall. We are on 6th of September, so we haven't had a green day, at least on the open and close basis. September seasonality will play a role. Short-term vol, you can't make any comment on, what's happening. You saw the news based on NVIDIA getting a subpoena, and the next day it comes out they didn't get a subpoena. So There are weekly expiry, daily expiry options. So it's difficult to justify what happens on a day-to-day basis. But to your point about increasing weight of India in emerging market, I don't think that changes, because if Indian economy grows and Indian economy delivers, then clearly the structural changes will continue to deliver, and investors are going to love that.
We'll have to wait for more data to percolate, and we don't have too long before the Fed announces its decision on interest rates and whether or not it's going to be a 25 or a 50 basis point rate cut on the back of the weak jobs data is going to be an important piece for the market. So we'll see whether the Indian markets recover, what Wall Street does. Right now, of course, it's a sea of red, but we'll keep coming back for your perspectives. Ajay, Bagga and Manish Singh, many thanks for joining us on India Tonight this evening.
If you like this video, then like, share and subscribe to ET Now.